Greetings, members, one and all of the Salivation Nation. I am pleased to bring to you Lior Gantz from Wealth Research Group. Lior, good to see you. There's been a lot happening in the markets over the past month here. What has happened recently is the Federal Reserve has raised the rates a quarter of a point, 25 basis points. The markets have acted pretty sporadically here as of late. Gold and silver up, but they pulled back a little bit here just the day before we're recording this video. What is your take on the overall sense of the drivers for gold and silver now, and where do you see us going in terms of gold and silver's price and what the Fed is doing, the over economic picture from employment? There's talk of more bank failures that could be coming along. PacWest and Western Alliance banks are now being talked about that they could possibly collapse. We'll see. But a lot to take in.
Yeah, I think in general what's happening is the Fed has ended the rate hike cycle. And because it ended it with inflation still very elevated, still very sticky, they have acknowledged that they're fine with it. So in other words, they are fine with inflation running hot, extremely hot, for a few years until we'll come back down, hopefully, to their 2%. But even they doubt that. They're talking more like 3%. And that's the big, huge change that we're seeing. If you can switch off your mind to the idea that inflation is transitory and just erase that and understand that inflation isn't transitory at all, it's actually very sticky, then you can get into the mind of Wall Street and the mind of central banks, because central banks are the ones driving the price of gold to all-time highs. That's why silver is not tagging along. If silver was tagging along, it's because the retail audience would be in it, but they're not. The reason that gold is doing so well and silver is just not performing as good is because this story with gold is smart money. It's institutional money. It's on the sovereign level, on the country level, on the nation level. What's happening is because the Fed has essentially capitulated and allowed inflation to keep running hot, and they don't want to raise rates anymore, that means, in general, that we are living in an inflationary environment, which is bad for the dollar. But here's why gold is at record highs and probably going higher. The reason is because the Fed is still saying to the markets that because inflation is so high and unemployment rates are so low and the jobs market is so resilient to interest rate hikes, that they will keep rate hikes here for a very long time. And the market disagrees. The market is saying, no, you will not be able to do that because there's too much stress in the banking system, and you will need to start cutting rates either in July or in September. And because of that friction between the Fed and the market's huge bet is that they are wrong, or that they don't want to admit the severity of the banking crisis. And when they're forced to, in other words, when the crisis is in front of us and you can't deny it anymore, then they'll cut. The market's being forward-looking. They're already starting to price in that reality. So that's why gold is doing so well. High inflation, dollar bear market, and the Fed will have to cut into this. It's the perfect environment for gold. High inflation and signs of a panic or a recession due to a credit squeeze. It's beautiful. It's just like March 2020. It's very much like 2009. It looks almost like a monetary event, like a 1971 type event. So very bullish for gold.
Silver, you talked about that briefly. In spite of it not reacting and performing as well as gold, I've always said that we may be in a new normal in terms of the gold to silver ratio, but notwithstanding, it's still doing pretty good. It's held its own above $25 an ounce for quite a while. In fact, it's only until like one day it was down 2 times below $25 an ounce. It's a duality metal. It's mostly industrial, but it does react along with gold at times. With the low unemployment numbers and with a resilient economy, I guess, notwithstanding, because the Fed essentially does not like that. They want to try to rein in the economy. What is your outlook for silver? It seems like there may be some industrial demand coming down the pike, and that's what the Silver Institute is saying.
For it to rally well above the cost of mining, and to have that premium that gold enjoys as a hedge against inflation, because to mine gold around the world right now it's around $1,100. So it trades well above that. And for silver to have the same type of premium, it would need to trade around 30, and it still doesn't. So it doesn't enjoy the same premium as gold does. But what will indicate its price is not how much industrial uses pay for it. Obviously, any industrial company wants to pay as low as possible for their silver. What dictates the price of silver on the COMEX in a bull market is speculation and retail speculation. So, and we're just not there. When we will be there, the gold to silver ratio will drop to 60 to 1 or 55 to 1 and even 50 to 1. And on that basis, silver should already be trading at 40. And if we're projecting forward, and I think that gold is going to head to the 2,500s and the 3,000 during this bull cycle, I think that silver has a good chance to break 50 and go up to as much as 60 or 70. It is a bull market. It's not up for debate anymore in terms of all the technical analysis, etc. Gold is trading at an all-time high versus so many fiat currencies simultaneously, including all the important ones, and it's just shy of its all-time high against the US dollar. So once that's confirmed, I think silver will start to join, because it will become much more of a confirmed story, and then the equities would join as well, meaning the gold, silver companies, the quality ones. So I think we are in a spectacular place, and because silver isn't joining gold yet, it tells you how much this is not a retail story, how much this is not like just a rally, how much this is a real bull market.
Yeah, and you talk about it as a retail aspect of it in terms of coins, rounds, and bars. We are seeing kind of an explosion in premiums there on that side as far as people acquiring the physical. There is sort of that separation we're seeing again from the silver spot price to the premiums and that you pay when you buy the silver, but also when you sell it, people are getting above spot for it.
But just to clarify, it's not the stackers that go to the bullion dealers and buy the physical silver that will dictate the price. If you're talking about the COMEX price, it is the retail crowd, but it is the 90% that don't buy physical. It's the 90% that join the retail mania and buy the silver ETFs and just track the price on the COMEX. When you have that disparity between COMEX and bullion, that's that's when you know it's not a real bull market. It's just the die-hard, I need to stack my own stash community that's buying it. So if you're looking for that inclusive bull market, that's not here yet. So even if you're seeing a lot of pressure on some bullion dealers, what you really want to see is the price of silver on the COMEX break the 2950. The 2950 is the last big resistance hurdle. Once that happens, it goes straight to 36 from the highest probability technical analysis, 85% probability.
Right. Okay. So retail meaning like the paper markets, the
Correct.
ETFs. Okay, I see. Right. Well, very good. And I'm with you. I think that in time that's kind of where we're headed. But now we've seen the bullish case. Let's talk about the other side. What would the path look like? Let's start with gold. What would it look like to get back to $1,500 gold?
In that scenario, what will happen is there will be no recession. A banking crisis will actually be avoided. Inflation will continue to go lower, and the Fed will be able to lower rates without creating further inflation. And so what you have again is a robust economy, a great recovery on all the industries, and a return to an investing style that is deflationary. So if you see that happening, that's how gold will get to 1,500. But there's nothing there that even remotely looks like that. So many things need to happen inversely to how they look right now for that to materialize. So yeah, I would say it's not the probability. Statistically, that will be amazing if all that happened. And by the way, just so you understand my point of view, if that happens, then the 10% of my net worth that's tied to gold will go down, and the other 90% that's long on growth, the world in general, etc., that will go up. So when gold is in a bull market, it means that that a lot of things are not going right in the world. That's where I think we're going. But everything starts to look really, really good, then gold's role as a hedge against the bear market in the dollar will be lessened. If you think a dollar is going to get stronger, then or if that's your scenario, then yeah, gold can go. It can go well below 1,500 in that scenario.
I kind of don't think that's going to happen either. I'm kind of with you. Now we're going to talk about the path to silver, and I'm not talking about going down to $20 an ounce. I'm talking $15 an ounce. A lot of the same type of things may be at hand. That might be the reasons why it could go back down. But can you think of anything else why silver could reach $15 an ounce?
Well, you're either talking about like a really severe recession, the type that you saw in like a 2008. If you think that that is coming, where you get to double-digit unemployment, and just the economy is in dire straits, then obviously silver is going to go down a lot. I don't know if you've already downloaded my portfolio just to have it as a reference point, but it's easily accessible at wealthresearchgroup.com/portfolio. You can simply download my entire portfolio, excluding any small cap companies. And every quarter, I listen to the earnings calls of all of the portfolio companies. And there are about 50 to 60 companies in there. So I spend about 60 hours listening to CEOs, CFOs talk and respond to questions. That's on aggregate, you're talking about around 10 questions per earnings call. So that's around 600 questions and answers that I listen to. And I can tell you the 20 that I've already done this quarter out of the 60, all of these CEOs and CFOs have acknowledged everything that has to do with how to align their companies with the new world that we're entering, which is a world of slow growth, very slow growth, with hard costs of capital. In other words, how do you get to a position where you don't need to borrow at all to grow? How do you get to a position of profits? How do you lose all the dead weight in the company? Any employee that's underperforming? And how do you make your sales better? In other words, how do you make your products or services more compelling? Everyone is working on this. The economy is in a recovery. We are recovering. These are not CEOs that are frantic over supply chains, frantic over inflation. These are CEOs that are taking proactive actions. And those are just 20 companies. If I listen to all the 500 calls, I can tell you everyone's doing the same thing. And what that tells me is that we are in this slow recovery or reset into this new world of very strict lending standards, very tight credit, very high borrowing costs. And, you know, if you can run a company successfully, profitably during this period, then obviously when the Fed starts to relax standards again, it will look even better. So I just don't buy the 2008 scenario because we don't have any of the same circumstances that led us there. I do see a problem where some of the regional banks have overextended their leverage and have gambled with depositors' money that interest rates are not going to go that high, and they made foolish bets, and those will be handled. But in America there are 4,000 banks. So if 2 or 3 or 4 or 5 or 6 or 9 banks have an issue, as long as it's not your Bank of America, Chase, Wells, and the other big ones, then we're okay. And the big ones are doing just fine. So, you know, it's always easy to go into this swirl where everything is going down, and we have the national debt crisis upon us and everything else, the debt ceiling and this and that. But you know, when you actually listen to the CEOs and how they talk compared to how they spoke a year ago, we're in a much better place. So what I think you should really think about is the fact that we live in a very inflationary environment. It will not be easy to take us down back to 3% and 2%. It will take years. We will live in a slow growth world during that time. And it looks like a very stagflationary environment, and that's really good for gold and silver.
The banking crisis. We hear about these banks, the biggest bank failure since 2008, and then we have this First Republic, which beat Silicon Valley Bank. There are 4,000 banks, but these are big banks. These are they're regional, but they are big, and they're obviously it's having an effect. And then you have Credit Suisse, you have Deutsche Bank. I've been talking about Deutsche Bank for years. There is a contagion factor out there. And what I see happening is the bigger banks like JP Morgan are swallowing up these banks, and they're just becoming bigger. And I don't know what's going to happen with some of these other very, very small banks. Hopefully they'll survive, and I think many of them are doing fine. But it's just going to be interesting to see how this plays out. But I think the fact that we have two more now that are under fear of potentially going down is not good, but hopefully it doesn't spread out more than that. But I definitely can see your point in terms of the inflationary environment we may be here for a while. When we saw it go from 6.1, I think, to 5%, the CPI, that was a pretty big disinflation move to the downside. But you look at where that 5% is on top of the already 8.1%, which we saw last year at this time. In other words, last year at this time is when we saw the maximum inflation numbers. In June, I think, was 9.1, I think, or somewhere around there, which was the apex of inflation. So this 5% is on top of those type of numbers back then.
Correct.
So if the Fed is going to be happy with 3%, because early on when they're talking about it being transitory, they were okay with 2.5%. So I think we are in a new era here with inflation, and so I'm with you. I think gold and silver are going to be pretty strong from here on out.
Yeah, sometimes the Fed waits until something is right in front of you before it also acknowledges it. And the analogy that I can give you is, let's say you buy a gift for your child, and you really want to give that gift to him. You love him, you want to spoil him. You bought him a great present, and you're going to give it to him tonight. But you tell him, hey, before I bought you a gift, but before I can give it to you, you need to do your homework, clean your room, brush your teeth, take a shower, and help mommy with this and that. Now, if he doesn't do it, if he does just half of it, you're still going to give it to him. You're still going to give him the gift. No matter what's happening, you want to give him that present at the end of the evening. But if you tell him that, if you tell him, hey, even if you don't clean your room, I'm still going to give it to you. Even if you don't brush your teeth, I'm still going to give it to you. Well, then what's going to happen? He's just not going to do it. So the Fed sometimes knows things and doesn't say that. In other words, it knows that there's a regional banking crisis. It knows that this is bad. But if it says that right now, then it will cause panic. And what it'd rather do is just say, look, I think we're watching it, it's under control, and if it ends up materializing to something bigger, then they'll address it. But I think they also know that it's a big problem and that more banks are coming. So that's my point, basically, that sometimes they just withhold information until the right moment in their view, to acknowledge it fully. So I think in terms of inflation being transitory, if you remember that, at first I believe they did think that a lot of it had to do with supply chains, and they didn't understand what's happening in demographically, where so many baby boomers have retired because of the pandemic and are not coming back, and the millennials, which are and Gen Z, which are a smaller generation, could not fill all these jobs very quickly. They did not understand the severity of the labor shortage, nor did they conceive that China would remain another year at zero COVID policies and closed. So between all of that, a big shift away from the dollar, and then the invasion of Ukraine, they did not understand or grasp how much we are moving away from globalization. and therefore how much we need to have redundancies. Because if you're deglobalizing, then it basically means that you need to build a new factory, even though you already have a factory, because you're moving out of China. It's almost like it's almost like you furnish the entire apartment, and then it's delivered to your house. And now that you see it in your house, you don't really like it, so you throw everything away and you buy anew. It's very inflationary to do that redundancy, but we are in that process right now in many aspects. So that's why we have a lot of inflation that's not transitory. Even when they understood that it's not transitory, they continue to say that for a few more months instead of acknowledging it early on. I think that was a huge mistake on their part. And I think that right now they're doing the same thing. They already know that it's a big problem, but they're obviously trying to solve it with these banks behind the scenes. And if they can't, and this spreads and becomes a very big problem, that's when I think that they will have to cut.
That's on top of all the quantitative easing that's going on as well, but that's another subject. But Lior, this has been fascinating. I really appreciate you taking the time to share with us your insight and knowledge. Fascinating indeed, kind of where things are going in the markets and research you have done, especially listening to all the CEOs and what they're seeing out there. I think that's probably the most important thing that people should know and take away from this broadcast. So I'm going to post a link down in the description below to the Wealth Research Group /portfolio for you to check out. And Lior, thank you again for taking the time to be here. I want to extend a multitude of gratitude to everyone else for taking the time to watch this video, and encourage you to please rate, share, comment, and subscribe.